Economists in Canada are expecting that we see a rate hold next week when the Bank of Canada makes its decision. If you want to find out why, keep watching the video. Hey guys, what's up? This is Brett. I am a realtor in the GTA, and this channel focuses on GTA real estate news, market updates, and educational videos, so you can stay informed when it comes to buying or selling real estate. If you find any part of this channel valuable, what I'd like you to do is consider subscribing to the channel, hitting the notification bell so you don't miss any of my upcoming videos. The GDP data came out yesterday, and what has happened is the economy in Canada has contracted by 0.2%. Economists were expecting a 1.2% gain in GDP. So if you don't know what GDP is, it's a standard measure of the value created from goods and services in a certain country over a certain period of time. If we're at a minus 0.2, it's a miss on projections by about 1.4%. We're going to take a look at an article in a second, but with this rate hiking cycle that we've been seeing, this is the actual goal of the Bank of Canada. So they want to see the economy contract, and that usually means pain for everyday individuals and consumers with higher costs. So they're actually spending less money so that the Bank of Canada can get to stable prices. A lot of times people just talk about, okay, well, we need to get inflation down. But in order to get inflation down, there's only really one of two things that the Bank of Canada is working with, and one tool only that they have, and that's to either raise or lower interest rates, because their stated goal is to maintain stable pricing and full employment. If inflation is high and we have high employment right now and very little unemployment, what that means is likely in the future is that, yes, we're going to get GDP contracting, and we may get the labor market contracting as well. When we say these things, the labor market contracting, what it really means is that people may lose their jobs. Let's jump into the article quick and see what caused the contraction. So this article is going to go over specifically what this GDP contraction means for the rate hiking cycle that we've been experiencing over the last year and a half. Economists say that the latest GDP data from Statistics Canada showing a contraction in the economy, like we talked about before, suggests that the Bank of Canada rate hiking campaign may be coming to an end. And that's probably a breath of fresh air to some of you out there for sure. The economy contracted at an annualized rate of 0.2% in the second quarter, and Statistics Canada reported far weaker than forecasts had expected. So we're just going to jump over here to our economic calendar. And we got this info out yesterday at 8:30 a.m. and the actual was a minus 1.2%. The consensus is that the economy was going to grow by 1.2%. And if you look here, the previous was 2.6%, and I think that's why we had a couple rate hikes throughout the summer. This is what contributed to the decline. So housing investment fell by 2.1%, and new construction dropped by 8.2%. And coincidentally, that's coming in a time where Canada is pushing, and the federal government is getting a lot of flack for not helping with the housing file. And, you know, in Ontario here, they've been actually trying to implement plans to build more housing. But you know what? They've been met by the same old, you're not allowed to build here. They say a labor shortage for laborers. Let's continue on. The drop in spending came as Canadians face higher borrowing costs fueled by interest rate hikes by the Bank of Canada, which is trying to bring inflation back to its 2% target. People are spending less because they have a higher interest debt burden when it comes to their mortgages, when it comes to their home equity lines of credit, their credit cards, their lines of credit, everything like that is affected by that overnight rate. The bank's goal is eventually to restore price stability, to taper an overheated economy. Their goal is to not incur a recession, so it looks like the bank is achieving their goal. And the next Bank of Canada interest rate decision is set for next week on September 6th. Taxes are never factored into these articles when they're talking about the rising price of living in Canada. But if we take, for example, the carbon tax, people are actually paying more taxes. We already pay high taxes in Canada, and it eats away at people's incomes. When we're talking about about the interest rate burden, which is, the topic du jour, it's often forgotten that Canadians are actually paying a lot more money in terms of fuel cost, in terms of food cost, because when we consider the carbon tax, it's going all the way up the chain, adding cost burden to producers, which are then filtered down to the consumers. So I wish when they're talking about the problems that Canadians are facing, that was more part of the conversation, because if we weren't paying for the carbon tax, it would likely be that people would have more money in their pockets to deal with this interest debt load burden that's been foisted upon them in this whole rate hiking cycle. I'm not going to get too deep into the weeds on that one, but if you'd like to know my opinion about the carbon tax and how it affects Canadian households, you can put a comment down in the description and I may do a video about it, because I'm just a realtor, I'm not an economist, but when it comes to affecting households and their ability to, say, buy and sell their home, I think it can factor into people's decision making because we are paying such high costs. Going back to rates, what could this potentially mean for buyers or sellers? I did a video a little bit earlier about the Durham region housing prices and what a rate hike could mean, and you can check that out at the link in the description. We kind of have some more solid evidence, and if we take a look back at that economic calendar, it was saying that the projected forecast is for rates to be at 5%, and that's a consensus now that they're going to hold rates because of this GDP contraction. So if you're a buyer in this market, all I can kind of go back on is earlier this year when they halted the rate hiking cycle, people came back into the market in force after March break, and we hit a peak in housing prices for the GTA in May. Are buyers going to come into the market in force again if we get a rate hold? That remains to be seen. But there is also going to be more inventory coming to market because after the summer, when you get into the fall, it's typically the second busiest time of the year when it comes to home sales. If you've been in your house for a while, if you're a baby boomer generation, or you are someone who's looking to upsize this fall, if they hold the interest rates, it may be a good time to consider selling if that is your stated goal. With the rate hold, what it means is that it won't affect the buyer's purchasing power, and if they're coming back into market in force, you may be able to get a good price for your house. And still, if you've been in your house for a long time, especially pre-pandemic, prices are still very high from that period. And in an earlier video I showed that since 2020, home prices in Durham are up by almost 35%. If you're interested in your prospects for a potential sale, what you can do is hit the first link in the description. It's always going to be to book a call with me, and we're going to wait, and it remains to be seen whether they hold rates or not, but we'll wait for September 6th, and that's the end of this video. We'll see you next time.